Hello, real estate agents. Stu Schmidt here with Oakster Funding, and this is another episode of Real Estate Pulse. Today is the 19th. Happy spring, everybody. Real Estate Pulse is a great platform that Oakster Funding has launched about education of the ever-changing mortgage industry, and knowing what's out there is used to grow your business. If you are here because of these two flyers that I put out there, one borrower financing either for 221 or 383, how can it be the same borrower in financing $160,000 difference between one and the other? What we're talking about is conventional mortgages versus FHA loans. Wait a minute. I don't do FHA loans, Steve. I've never done it. They're negative things, and that is not the case. If you've always thought that FHA loans are a negative thing, or that means the borrower's is not well qualified, we're going to have a harder time, please continue watching this video. I put together a nice little program or a nice little flyer about FHA versus conventional. First of all, what is FHA mortgage? FHA loans are Federal Housing Administration loans that are insured by the U.S. government. Conventional mortgages are insured based upon Fannie Mae and Freddie Mac guidelines. Fannie Mae and Freddie Mac are not owned by the U.S. government and can, just like how the banking industry is kind of going through a little rough patch right now, it can affect those Fannie Mae and Freddie Mac backed securities. FHA, not as much. The U.S. government has to have a lot of problems before it's going to majorly affect an FHA loan. So looking at this flyer, I put together for a scenario based upon the two flyers that I showed you. We got a borrower. Okay. He makes about $90,000 a year annual salary. From a broker standpoint, and how we analyze qualifications of a loan is that we always start with the income and we break it down on a month-to-month basis. On an FHA loan, you could actually push your debt to income ratio as high as a 56 or 55.99% debt to income ratio. So at a 55%, we actually have income of $4,125. On a conventional, traditionally, you want to make sure you're not exceeding a 45% ratio, especially with a 700 credit score. Unless there's other major compensating factors, you're not going to get that approved eligible at a 700 credit score if you're exceeding a 45% ratio. Okay, so again, FHA 4125, conventional 3375. Right there, you could see the difference. We have more income. We're going to be able to qualify for more of a house just to base upon debt to income ratio alone. Then what we want to do is we need to take into consideration all the other clients' revolving debt that's out there that's on a credit report. Once we look at a credit report, we're going to see, does the client have a car loan? Do they have any student loan debt? Do we have any credit card debt? Do we have any other installment loans? So for this client, I actually gave a general scenario of car loan of $650 a month, student loan of $200 a month, credit card of $150 per month, and a installment loan, furniture, electronics, something else, about $100 a month. So we actually have about $1,100 worth of debt that's out there. So we are actually going to have to take that and subtract that out from the income that we're able to use at that 45% ratio. Because remember, total debt to income ratio cannot exceed those thresholds out there. So what we have left over is income used to buy a house. Okay. So an FHA in this case is $3,025, conventional is $2,275. Then we have to take in consideration, and we look into it. I did an apples comparison, the same down payment, 5%. And then since we're only putting down 5%, let it be on conventional or let it be on an FHA, you're going to have PMI or MIP. MIP is mortgage insurance premium for FHA. PMI is private mortgage insurance for conventional backed mortgages. Okay. There is a site, you can't see it on in the small writing. There is a site called Rate Finder. Again, if you want to have the link for Rate Finder, please don't hesitate to reach out to me or email me at sschmidt, SSCHMIDT, at oakstarfundingllc.com. And then I could actually send you the link for it. What it is a PMI finding website that you will actually calculate your PMI that most lenders are actually going to go after. Okay. So with a 700 credit score, FHA, MIP is going to be the same. 740, it's going to be the same. 780, it's going to be the same. 660, it's the same. It's that 0.5. On a conventional, PMI will vary based upon debt to income ratio. Are you exceeding a 40% debt to income ratio? It's going to have a factor. Credit scores, a 660 is going to have a higher PMI than a 700, then a 680, then a 740, 760, 780. So again, a 700 credit score, you're going to actually, with most lenders, your PMI is going to be higher than even an FHA. So that's going to eat into our availability of the dollars that we have left over after that revolving debt has already been subtracted out. Okay. Now, once we actually have an idea of what that PMI is going to be or that MIP is going to be, then we actually want to look at the other factors: taxes, insurance, HOA, if the property has an HOA on that. If you have a broker or you're dealing with brokers that are not asking you, what are the average taxes in the area that you're looking at? They're not doing you justice. They are pulling numbers out of the sky and estimating what is going to be. But they really should be asking you the area that this person is looking for, your client that's looking for, what are the average taxes in the area? Especially in Texas, our taxes could range from, I'm doing a loan for somebody that has taxes of $1,500 a year, and then I have some people that I'm doing a loan for that has $12,000 in taxes a year. Is that going to affect their availability or their qualifying ratios? Of course it is, because again, the property taxes have to be taken into consideration when we're calculating an overall debt to income ratio. Okay. The next one is interest rates. Now, these are the rates as of last Friday of what we're looking at. On a conventional with a 700 credit score with Oakstar Funding, the rate on that would be on about a 6.451. On an FHA, it's about 5.402. Historically speaking, FHA rates are historically lower, even when the rates were low on a conventional. They're historically lower on an FHA loan than a conventional mortgage. In this case, and where the market is right now, it's about a full percent less. So you guys, we have some positive things here. We haven't even talked about that this guy is a 700 debt to income ratio. We're going to be fine. I'm not saying anything negative about this client, why I would take him FHA versus conventional. He might qualify for conventional, but again, let's say he's looking for financing $300,000. Conventional, he's not going to qualify. So we're going to take him FHA, going to push that debt to income ratio a little bit more, that qualifying ratio a little bit more, and get him in that house that he's most excited about, or the client's most excited about across the board. So having that lower rate, having that lower with an FHA of that lower MIP, that payment's also going to be at a better level than if we went a conventional on an apples kind of same monthly obligation, or that same $250 versus $250. Who's going to have the cheaper payment? In this case, would be that FHA loan. So when you are looking at FHA and you get a pre-approved letter, or you're seeing conventional / FHA on a pre-approved letter, please don't have that knee-jerk reaction. Say, I don't look at an FHA pre-approved letter. I'm gonna set those aside, and I'm not. We have another offer. We're gonna look at that. Go back to the broker. Call the broker up and ask them, is this an improved eligible FHA loan, or does it require a manual underwrite? Wait a minute. I thought FHA, a bank has to look at it. They do. But like a conventional mortgages will, as you know, will be run through Fannie Mae and Freddie Mac's automated desktop underwriting. Fannie Mae's DU, desktop. Freddie Mac is LP loan prospect. FHA is also run through either Fannie Mae or Freddie Mac. And if you're going to get an approved eligible going Fannie Mae and Freddie Mac and an FHA, that it's the same or equivalent of getting that approved eligible on a conventional Fannie Mae, Freddie Mac. Okay, so never hurts to call up that broker. Are we going FHA? Because again, I mean, if you don't want to say because are we pushing the envelope, just ask them. The FHA that I have, that letter, have you already run them through? Do we already have an approved eligible, or does it require a manual underwrite? And they tell you, no, we're approved on that via, their loan amount. Then you can pretty much take that to the bank, just like how it is on a conventional. Still has to go through underwriting. Underwriter has to analyze everything because we don't have a purchase contract. But again, if a good broker is doing their homework, I run Fannie Mae and Freddie Mac 1, 2, 3. I do not know Lane. A lot of times just to make sure that we actually have an approved eligible, even before a pre-approved letter is issued from Oakstar Funding, because again, that letter is our bond. So real estate agents, FHA, don't shy away from FHA, especially with the rates in the market being where we're at right now. We're not seeing those rates coming back down anytime soon. Okay. Are they predicting? Yeah, but when is that going to do? Are we going to hamstring our business for the next 6, 8, 12 plus months until those rates come back down? No, we want to go out there. We want to actually still get those clients. We still want to get them in those dream homes that they want to do. And again, if they can't go conventional due to debt and racial issues or due to something else on there, never hurts to actually go out there and say, hey, you know what? Can they go FHA? This is Steve Schmidt with Oakstar Funding. If you want to know anything more about FHA versus conventional, please don't hesitate to reach out to us. Our numbers are posted all over our YouTube, Facebook. You might have gotten an email from me that has basically every which way under the sun on how to get a hold of me or anybody within my company. You want to just know a little bit more about any of our other programs or any other videos that we did, please don't hesitate to reach out to us. Everyone, happy spring. Let's go and actually make a phenomenal 2023 real estate market that's out there. Everyone have a great day. Thank you very much. Bye-bye.